Hello, and welcome to the September edition of the U.S. Energy Insights. My name is Pamela Munger, and I will be your host today, where we talk about market trends and actionable insights powered by Vortexa's analytics. Today, we will be looking at OPEC exports and the latest news on cuts. We'll also take a look at U.S. exports heading over to Europe, the strength underpinning the clean product market, and of course, the Russian flows in terms of vessels moving out of the Russian trade and into more of the mainstream trade for both crude and clean products. So this week, we've learned that both Saudi and Russia have come out and announced a prolonged cut to the current 1 million barrels per day of production cut for Saudi and 300,000 barrels per day of export cuts from Russia. Now, we expected that cut to happen in October, but they've announced that they are going to prolong that cut into December. So let's take a look at what we're seeing right now in terms of OPEC plus crude export volumes at sea. So if we look at the chart on the left-hand side, you can see the Saudi volumes have come down quite significantly, indicating indeed a cut of around 1 million barrels per day. The Russian volumes have also come down, but only at about 100,000 barrels per day. And as you can see by the blue line, that indicates OPEC plus, which is excluding Russia and Saudi, indicating that the remainder of the OPEC countries are continuing to export at regular or, in some places, higher volumes. Now, if you look at the right-hand side chart, what we're looking at arrivals of crude and condensate from OPEC plus countries. And you can see there's a slight disjoint in terms of the volume of imports coming in versus the drop of exports leaving. And now, although some of it can be explained from a timing difference, what we've also noticed is large volumes of crude at sea being drawn down, especially the Saudi volumes. We've actually noticed that there's been 1.5 million barrels per day in August of Saudi crude floating vessels at sea that have come down in combination with a 4-week average drawdown of global crude inventories. This is indeed looking like a strong market in terms of crude supplies. So let's also take a look at what impact has this had on the VLCC markets and the Suez Max markets. So if you look at the left-hand side chart, you can see that utilization out of the Middle East Gulf for VLCCs has actually decreased. And we see those vessels, you can see this indicated by the light blue portion of the chart on the right-hand side. These vessels have largely been moving over to the US and taking over that US to Europe flow. And you can see those ton miles out of US Gulf to Europe increase on the right-hand side chart, again indicated by the light blue showing the VLCC vessel class. At the same time, we've also seen utilization of the Middle East Gulf increased for Suez Maxes. And this is largely driven by that reduction of barrels coming out of Saudi Arabia and, of course, Russia as well. Now let's take a look at U.S. crude exports. We've seen in the month of August that U.S. crude exports into Europe have hit a record high, another record high, because we also saw that hitting high levels in July as well. What we expect going forward is we could possibly see reduced volumes as U.S. exports get redirected into Asia and possibly fewer barrels coming into the European region. Now let's take a look and turn our heads towards what's happening in the clean product market. First off, we're going to take a look at what's going on in Latin America. And if you look at the left-hand side chart, you can see that Latin America diesel imports by shipping regions and where those are coming from. And so you can see, noted by the blue columns, that you see rising volumes coming in from the U.S. Gulf Coast and the Gulf of Mexico. And at the same time, you can see fewer volumes coming in, certainly from the US West Coast, but more importantly, fewer volumes coming out of east of Suez, which is underpinned largely by fewer volumes coming out of Asia. The red line indicates the total share out of Asia, which you see drop quite significantly at around May, June time period. It's rebounded a small volume, but we also see those barrels staying into Asia and not coming into Latin America West Coast. We see those barrels more and more coming out of the US Gulf Coast, which of course is causing congestion at the Panama Canal, along with the slow rate of water due to the drought happening there. Now, looking at Latin American East Coast and Caribbean, you can see diesel imports again by origin shipping region, and you see that strong pull coming out of the US Gulf Coast and a rising share again coming out of that region. The yellow portion is indicating those volumes that we still see coming out of Russia to fulfill that Brazilian demand, which we don't see that stopping necessarily anytime soon. But again, large pull on US Gulf Coast, volumes of diesel as we head into winter, and fewer volumes coming out of Asia. Now let's take a look at what's happening in the east of Suez. So what we're seeing is that although east of Suez liftings are higher in August, there's an increased share that's actually pointed to Europe, which is really underpinned by the Middle East. In the last couple of months, what we've seen is we've seen the arb relatively closed out of Asia in the Middle East to Europe. We've also had lower volumes of diesel from the intra-regional portion of Europe due to unplanned outages in the region. Those look to be returning, and we expect we expect to see more resupply coming out of the Middle East, barring what we are now looking at is relatively high turnarounds in the Middle East, especially for the October period. We've also seen fewer volumes coming in from Asia, especially West Coast India, and India will also be starting their turnaround season in September. So the points of resupply certainly are looking tight, and there's going to be many regions that are pulling from that same resupply points. Now let's take a look and cast the net to the further Atlantic basin, or the wider rather Atlantic basin market, and we'll look at the diesel arrivals into Europe by origin region. So as we know that European stocks, especially for diesel right now, are very low, and the arb from Asia and the Middle East has been relatively closed in the last few months, as well as intra-European diesel supplies have been hit by unplanned turnarounds in Europe, refineries suffering from the heat and of course having to turn down their runs. So the resupply points for diesel in Europe have been relatively slow and lackluster. Now what we're looking at is we are seeing European flows kick back up, as you can see in the blue bars, and you can see relatively steady flows from the Middle East, although fewer volumes it looks like in August compared to July. And what we also see is a reduction of diesel barrels coming in from Asia. And two important points to make about this is as we look forward into, as we're now in September, we look forward to October, we start to see refinery maintenance season kick in, especially for the Middle East and Asia. And of course, this will tighten the overall resupply point for diesel, especially from Europe. Now, in addition to that, we've seen diesel barrels coming in from the US, from Pad 3, but those, of course, will likely be redirected to Pad 1, which we know are currently having very low stocks and also their own set of refinery turnarounds in the region, which we'll go over in a little bit. Now, if you look at the right-hand side chart, we're really looking at east of Suez total diesel liftings by destination region. And this is where we see these diesel liftings being pointed to currently. And if we can look at August, you see a slight jump in exports pointing towards Asia. And you can also see more barrels are headed towards Europe from a month-on-month basis. So overall, the percentage share looks like it's rebounding slightly, pointed towards Europe in terms of barrels coming out of the east of Suez. But of course, the levels have not returned to those high levels that we saw at the end of last year and the beginning of this year. Now turning our heads towards pad 1, hitting very low stocks, bottom of the 5-year range. And we also know that the Delta refinery is going on turnaround, as well as the St. Irving East Coast Canada refinery going on turnaround as well, which is a major resupply point for clean products into pad 1 area. So on the left-hand side chart, you can see that large share from East Coast Canada of diesel arrivals into the region. Well, we can assume that those barrels will indeed drop to those lower levels, and you'll see fewer supplies coming out of East Coast Canada, as well as fewer supplies coming out of locally from pad 1. Now, what this will likely mean is a strong pull, of course, from the Colonial Pipeline and from pad 3 refineries of diesel moving into pad 1. And now let's turn our attention to what's happening with the vessel trade in Russia. As we know, we have been relatively surprised since the invasion that we've seen a high number of vessels who've moved to the Russian trade and predominantly stay in the Russian trade. Now, on the left-hand side chart, what you can see is this focus is on crude vessels, and it's separated out, of course, by vessel class. But what's interesting is you can see those Russia crude ton miles start to slide down. And this is in conjunction with two events. One is the possible breach of price cap for Urals, which has likely caused some of those vessels to move away from the trade. And it's also underpinned by just the reduction of crude exports from Russia that we've seen. So that's causing those crude ton miles to decrease for those vessel classes and move more towards the mainstream trade. Now, on the right-hand side chart, what we've noticed is relatively the opposite for the clean product market. So you can see that the clean product market ton miles have seen relatively few changes in terms of the total ton miles. It stayed relatively stable. What we're seeing is that the clean vessels are staying in the Russian trade. It's likely to explain because diesel is the higher margin product, and of course it's in Russia's best interest to continue to export as high volume of those diesel barrels as they can, especially during the wartime economy. Thanks for joining. And before we go, I just wanted to say that we're having an innovation series in New York and Houston. New York is on September 20th and Houston September 21st. It's a face-to-face get-together with the analysts and data scientists looking at the latest innovations in energy and market trends. And we hope to see you there. Thank you very much for joining.